ACECRT's March webinar on Mastering the Basics of Investments. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. At the end of the webinar, we'll take the time to go through these together. Third, there will be polling questions throughout today's webinar. All results are anonymous, and we appreciate your participation. Now, I'd like to introduce our educator, Courtney Shipley-Gardosic of Lovejoy Associates. Courtney has a diverse background in the retirement plan industry, providing a unique education foundation in the areas of fiduciary responsibility, investment analysis, and investment education. During her career, she has provided institutional investment consulting to qualified retirement plans, developed business strategy for a boutique third-party administrator and record keeper, conducted over 9,000 401k, 403b education meetings to groups and individual employees, and served the corporate, nonprofit, and government markets. A graduate of Vanderbilt University, Courtney is licensed as a retirement investment advisor representative with the Series 66. She holds the Accredited Investment Fiduciary and the Chartered Retirement Plan Specialist designations. Thank you so much for presenting today, Courtney, and now I'll turn it over to you.
Okay, sounds good. Thanks everyone for joining. We've got a really fun presentation here. Today we're going to be, talking first about asset classes. We're going to cover what those are and what you need to know about them, risk and return dynamic, the trade-offs that you have to walk there, what drives returns on investments in general, diversification and rebalancing principles, and then we're going to talk a little bit about how to read a Morningstar report, and finally we'll wrap up with some wise reminders about the best types of ways to invest. So first up, we've got a polling question for you. What does financial wellness mean to you? So we've got three options here. The first is paying your bills on time. Does financial wellness mean contributing to your 401k, or does it mean having the tools and resources to reach your financial goals? So go ahead and fill in your answer there. All right. Okay, so 93% of you say having the tools and resources to reach my financial goals, which is great because that was our thought too. And of course, you'll have the opportunity after the webinar to speak with someone at PensionMark if you have more questions and need more of those financial tools. So moving on, we're going to be talking first about asset classes. So in your retirement plan, here if my mouse is working, there we go. There are three different types of asset classes. The first, stocks, also known as equities. The second is bonds or fixed income. The third is cash or stable value investments. Let's talk about each one of these a little bit. For stocks or equities, the objective there is for getting growth over time. With bonds or fixed income, this is more about preserving monies or just growing them slowly, paying interest. And then cash or stable value type of investments are there mainly for preserving monies. Now, each one of these asset classes acts differently in the market. You'll see different types of fluctuations. You'll see different risk parameters that go with these three. So we're going to drill down into those. It's important to know that every type of investment has a risk associated with it. If you bury your money in the backyard, of course, the risk there is that your dog will find it and dig it up. Just kidding. But seriously, the most important thing is that you keep up with and outpace inflation. And so when it comes to investing, we're going to be looking at what is your comfort level with risk, and then what rate of return can you expect for the level of risk that you are willing to take. So those are the things we'll be concentrating on here. So back to our stocks, bonds, and cash. When we talk about stocks, at its most basic level, this is where you have bought a little piece of a company that you can call your own. So think along the lines of Walmart, IBM, Exxon, Coca-Cola. So with stocks, we know that the stock market goes up and down. There is significant volatility that goes along with investing in stocks. But we know that over the long term, this has the highest potential for a high return. Now on the bond side of things, Bonds at its most basic level is where you've loaned money out to an entity and they are paying you back over time with interest. So this could be like a corporate bond, or you've loaned it to a corporation, or a government bond. There's two risks here that we've named. One is the risk of an interest rate rise, and the other one is the possible default by the issuer. So what if they don't pay you back over time as stated? Now, the third option here, the third type of investment was the cash or the cash equivalents. And this is like cash, things you can turn back into cash quickly without losing much or any value. And of course, here we're worried most about inflation. We don't want our dollars in the future to not buy the same amount of stuff as they will today. And as inflation goes up, it eats away at your buying power. So those are the three types of investments that we have in your retirement plan and the risks that go along with them. Now, there's other risk factors too that affect everything, like economic and political events, the interest rates going up or down, inflation, natural disasters, and of course consumer confidence as well. So looking at the history of the market here, we have from 1926 to 2016, and you can see that we've got small company stocks in dark blue at the top. They averaged a 12% rate of return over that time period. We've also got large company stocks like your Walmart and GE. Again, they've averaged 10% rate of return. Then there's government bonds in orange, those 5.6% rate of return, treasury bills at 3.4, and then you can see at the bottom in gray, that's inflation over time, 2.9%. So we want to make sure at a minimum that our investments are at least, or our dollars in our retirement account have the same spending power in the future, and so that they are at least keeping up with, hopefully outpacing inflation. Now, if we zoom in on any one part of that chart really closely, then you're going to see a lot of ups and downs, lots of volatility, especially in the stock type of investments. This is not a smooth ride. So keep that in mind, that we're focused on the long term. So another way to look at it is to zoom in on the downturns that happened between 1990 and 2016. So this can give you a little bit more idea about the type of loss you might have to stomach at times in order to invest in the stock market. If you look at the blue there, the blue lines represent the S&P 500 index, and it's just when the stock market turned downward. So you can see shaded in 2007 to 2009 timeframe, a lot of people were in a lot of pain. So remember, we're looking at the long term, we're not looking at the short term, but there will be both ups and downs in your account when you invest. And so what we're doing here is dialing in the amount of risk you're willing to take to make sure that you're on the correct roller coaster ride for you. So in your plan, we have what are called mutual funds. What that means is that there's a pool of money that's being managed professionally by a money manager or a team of money managers, and they're looking at buying a pool of investments, so lots of different stocks or company stocks or bonds or cash equivalents to a certain mandate. So maybe it's all large companies or all small companies, something like that. And they're either going to invest only in stocks or bonds or cash equivalents, or it will be a mix of all of those asset classes. So when it comes to investing, you have lots of different options in your plan. You probably have all of these in there, stable value all the way up to some sort of developing markets fund. And what you need to remember is that every single one of those has a risk level that goes with it. You can see the arrow on the right-hand side shows going from less risk to more risk, less volatility to more volatility. And remember, it's a trade-off. If you're not willing to take on much risk, then you don't have much of a potential for a high return. The most important thing here is that we're trying to decide how to divide our money out between stocks, bonds, and cash. We call that asset allocation, and we want to make sure that we're diversifying. We're not just putting all of our money in one of those. So each one has different different objectives. We have to remember that. And you'll dial in how much goes into stocks, bonds, or cash, depending on how much risk you're willing to take as an investor. So here's our argument for why it's important to diversify among those three types. And remember, inside those three types of asset classes, we also break them down even further. So for stocks, we might talk about foreign stocks or large company stocks. For bonds, it might be global bonds versus government bonds, and so on. But what you're looking at here is a chart that looks like the periodic table. What we have is the years going across the top from 1997 to 2006, and then we ranked in order the best performing investments all the way down to the worst performing investments each year. And we're looking at the asset class itself. So for example, if you look at 2009, the large cap growth category was the winner at 37.21%. But if you look at 2010, they were in fourth place at 16.7%. And then in 2011, they stayed in the same place, but 2.64% rate of return. If you look at others, you might see that commodities in the light purple, they bounce around a whole lot. Same thing with the real estate investment trust in light blue. And so what the point here is that you'll never know which asset class will be the winner that year. So it's important to have all of them in your portfolio so you can take advantage of all the market has to offer each year. The other thing to learn from this chart is our principle about buying high and selling low. That's not a way to make money. You want to buy low and sell high. So what this chart shows you is that even though large cap growth was the winner in 2009, the very best time to purchase large cap growth investments was not in 2009, it was the year prior when it was listed as a negative 38% return in 2008. And that's pretty hard for a lot of folks to want to buy something that has lost value. But what this chart shows you is that every single one takes its turn at the top or at the bottom and somewhere in the middle. So you'll always be upset with something in your portfolio because it's not performing as well as you would like, and there will always be a winner. So make sure from a diversification standpoint, you've got everything in there so you have both the winners and the losers each year. Now, in your plan, we've made this pretty easy. We're really asking you just to make one decision, and that is, are you a hands-on investor or are you a hands-off investor? So far I've talked about constructing your own portfolio and how you go about doing that, and that's more aimed towards the people who are pretty hands-on, that they want to choose their own investments. So they feel comfortable with the concepts of investing, they've got the time to keep up with this, and they want to dial in the risk to match how much, dial in their portfolio to match how much risk they would like to take. So the other end of the spectrum would be someone who is more hands-off. And that's the folks who say, where's the autopilot option for this? I'd like to kind of get it going, but ignore it generally. So I would like some guidance on this. Where do I go from here? So for those folks, we have what are called target date funds. And before we get any further, we're going to ask you to take another poll here about target date funds. What's the unique feature? And if you don't know, that's okay. You have three options. The first is they have a fixed rate of return. Second is they become more conservative as the targeted date approaches. And then the third is I'm not sure. And this is just gauging to see where we go next with our presentation. So go ahead and fill that in. Take your pick there. All right, 66% say they become more conservative as the target date approaches, and that's the right answer. So we're going to fill in, kind of drill down a little bit more on this. So target date refers to a date in the future. Let's see if my mouse will get going here. And what's interesting about these is that they already are pre-built with stocks, bonds, and cash. So what happens here is they're professionally managed, and there is a date in the future, usually between 2010 and 2060, somewhere in there, where they are targeting that as your retirement year. So for most people, that's when they'll turn age 65. And then from there, the portfolio is actually diversified according to your age and the distance you have from today to that retirement date in the future. So what happens is the earlier you are in your career, the more stock investments, the more risk you take on as an investor. And then over time, these types of investments become more conservative. Do you go from being aggressive investor to more conservative investor as you get close to and past your retirement date? So it kind of makes you automatically follow the good rules of investing as long as you're comfortable with the fact that the further you are from retirement, the more potential volatility you're going to see. So you lose control about the ability to choose how much risk you have or how much you're taking in the portfolio, but you're getting basically you're getting professional management on it. So when you go to choose a target date fund, you find the year that's closest to when you think you'll retire, and you use that particular one. You put all your money in it, and it's diversified from there. So here's a chart that shows how it becomes more conservative over time. So on the left-hand side of the chart, you'll see years to retirement going across the bottom. So if I am 40, 30 years out from retirement, the majority of my money is going to be invested in stock funds. And then as I get closer to retirement, that decreases, and then as soon as I get past retirement here, we definitely see a decrease to where it finally ends up at 80% in bond funds and only 20% in stock funds. So that glide path there happens automatically for you without you having to do anything. So as long as you're okay with taking on more risk, the earlier you are in your career, the further you are from that retirement date, then this is a good option for folks who really want a hands-off approach to retirement and want something that's going to automatically diversify them and make them follow good rules of investing. All right, now for our polling question number 3. What is the major driver of investment returns? What is it that's going to make the most impact on your account? Do you think it's market timing, getting in the market at the right time, that is, or getting out at the right time? Is it security selection, so is it the particular investments you're going after? Or is it asset allocation, so dividing up between stocks, bonds, and cash? Take a stab at that one, and we'll talk about it more here in a second. Asset allocation, 78%, very good. That is the winner here. We're going to talk a little bit more about it as we move forward in the presentation. So what drives investment results? When you take a look at, is it choosing the right securities, is it timing the market and making sure you get in at the right time, or is it how much goes towards stocks, bonds, and cash? The answer is asset allocation, or how much you put towards stocks, bonds, and cash in your portfolio. That's going to be the single driver of the variability of results that you have from investing. Surprising, I know, but that's how it works. So let's look a little deeper at this. Here are 4 different portfolios, and they're all diversified. So this is historical performance from 1926 through 2016, so nice long period of time. If we look on the left-hand side here at the conservative column, we've got this portfolio. It breaks down to 20% stocks and 80% bonds. So out of that, 30% is in short-term bonds, and we have about 50% in regular intermediate-term bonds. We have 14% in U.S. stock and 6% in foreign stock. So looking at this time period, the average annual rate of return was just under 6% over this time period. Then we have the best 12 months. During the best 12 months of that time period, the portfolio averaged 31% rate of return. During the worst 12 months, it dropped 17.67%, so negative return. During the best 5 years, this is just the short term, but looking at the 5-year period, 17.2% rate of return, and the worst 5 years was negative, just under 1%, basically, 0.37%. So what can we take away from this? Well, in a 20% stocks, 80% bond portfolio, you can see the spread or the variability of your results here, from illustrated pretty well from the best 12 months to the best or the worst 12 months. So during that period, you would have felt really good about things at some points in time, and you would have felt pretty lousy about it another time. But let's go over to the aggressive growth portfolio so we can illustrate the difference here. So in the aggressive growth, this is the inverse. This is 85% in stock investments, 15% in bond investments. So the average rate of return during that time period was 9.62%. Doesn't sound so shabby, just under 10% rate of return. That's great. The best 12 months, you were like out of control excited, 136% rate of return. But the worst 12 months, negative 60.78%. During the best 5 years, just under 32%. During the worst 5 years, negative 14% basically. So you can see there's a very big difference between the best and the worst here, between the conservative portfolio and the aggressive growth portfolio. Which one's right, which one's wrong? Well, it's what you can stomach. So when you dial in how much risk you're willing to take, you need to take this type of thing into consideration. What are you willing to endure in order to have the potential for more growth in your portfolio? That's why diversification and also asset allocation are very important. So moving on here, a good reason to monitor your investments. Well, we've got a couple of things. First off, things change over time. Your life changes. You may need to revisit your retirement portfolio because you want to take less or more risk, depending on where you are in your life or what's going on. The second thing is what we call rebalancing. So if we have a portfolio and we put 50% in stocks, 50% in bonds, so you start out even Steven here. After a while, one of these two is going to grow faster than the other because of how the market reacts over time. So in this case, we're illustrating that stocks grew more and they became a higher percentage of your portfolio. Bonds were less of a percentage of your portfolio. So in order to restore our initial allocation 50-50, we are going to sell out of some of the stock investments and purchase back into the bond investments so that you get back to that 50-50 allocation. So the same thing can happen in your portfolio, like what we were looking at before, where you have lots of different ingredients in the asset classes. You want to make sure that if one grows significantly more than the others, that you're selling off at the high point and purchasing into the others that may not have performed as well or maybe just aren't as big a portion of your portfolio, so that you're dialed right back into that risk allocation that you wanted. Now, if you're a target date investor, this happens for you automatically, so you don't even have to think about it. You'll just want to revisit your investments from time to time and make sure you still want to use the target date fund and you don't want to switch to something else. Here's a really fun chart. This is the 15 stages of emotional investing. So one thing that's really hard for us to think about is like retirement is usually a long time away. And between now and then, we're going to see ups and downs in the market. We've already seen several. We've been in a bull market, meaning things have been going pretty well for the last 8 years. And it's hard for people to think back to 2008 and 2009, where we hated everyone because the stock market had gone down so much. So here's how things tend to work through. You know, there's kind of this optimism and excitement about being invested, and then the market's doing really well, and we say things like, wow, I feel really great about this investment. I want to take even more risk. And then anxiety starts to set in because things turn. You might see temporary setback. I'm a long-term investor. It's okay. Everything's going to be fine. But then the market continues to go down. We end up in a recession, something along those lines, and you see desperation, panic, all of this start to kick in. And that's when we get phone calls where people are saying, maybe the markets just aren't for me. Maybe I should sell everything I have and go to cash before things get any worse. And unfortunately, that's usually right around or right before the bottom point where things start to pick up again and go right back into the same type of cycle. So when it comes to investing, the most important thing is pick your strategy and stick with it. So whatever that risk-based portfolio was or your target date portfolio, just stick to it. The greatest thing about investing in a 401k plan for certain is that you're putting money in every single paycheck as long as you're contributing. And so what happens then is during the down periods of the market, that's when everything's on sale. So you're buying the same shares of Exxon and Coca-Cola and IBM, whoever, at a lower price. So just think of it like the after Christmas special, and then when things do pick back up, your money's going to have purchased more shares at a lower price, which is what we want in the long term. So keep the course and don't jump off the boat just because things look a little rocky. Our last stop here before we talk about some other investing tips is reading a Morningstar report. So we get this pretty frequently. The first thing to know about all investments, or rather mutual fund investments, is that they have a ticker symbol that goes with them. It's a 5-letter abbreviation for the fund. So in our example here, we're using VSIAX. So if you take that ticker and you plunk it into your favorite search engine, you're going to be able to pull up information about this particular investment. And one of the line items you'll see on the search results is a link to Morningstar, which is a reporting and rating service. It's a pretty popular one, probably one of the most well-known. And so when you pull up what's called a Morningstar report, you can get a lot of information in one place about that type of investment. So looking down at performance, this is the performance of the fund through a certain date and time. You have the 3-month performance, year-to-date, 1, 3, 5, 10-year returns. These are all reported net of fees. And you can see them compared to their Morningstar category, so how they do against their peer group. Then over here, they'll have a star rating of some sort that you can, a 5-star is what Morningstar considers to be the best, goes all the way down to 1 star. So they rate their funds with their own policy for how they do that, but it will give you an idea about how this particular fund invests, what it's seeking to do, the composition of it. So this will tell you the top 10 holdings in this case. It's got to be a large cap, large cap blend fund. So we've got Apple, Microsoft, Exxon, Johnson & Johnson, Amazon. These are all names you recognize. When you look at small cap or maybe international, you might not recognize the top 10 holdings as well, but it just gives you a good idea of how this is investing. And then towards the bottom here, we've got the top sectors. So a little over 18% is invested in technology type of companies, and you can see how what the breakdown is from there. So it's a great way to get a start if you're a very hands-on investor, where you can get some information about each one of the different options in your plan. You can also go directly to the website of the fund company as well. So that's another option. So a couple of words to the wise before we wrap up and take questions here. The first is to know how you are invested. We've talked to a number of people who sometimes have signed up for the plan, but they just picked whatever the default investment was, or they didn't pick and ended up in the default investment. So you'll want to go in there and make sure you know where your money is, because as we know, asset allocation makes a big difference in the variability of your results. Considering your time frame, so how long you have for retirement, do you have time to ride out the ups and downs of the stock market, and are you able to invest more aggressively, or should you go more conservatively? So that plays in, as does your comfort level with risk, to how your portfolio should look. Make sure that you create an asset allocation that's appropriate for you, and that you revisit it, because it will change over time. So when you make those changes, it might be to rebalance, it might be to start over and say, I'm no longer an aggressive investor, I'm comfortable, I will not be conservative, or so on. And being realistic about returns is important. Most retirement plan calculators use a 6 to 8% rate of return as a long-term investment return. So what we're saying here is you probably shouldn't expect to get a 12 to 15 to 20% return on your portfolio. That's not realistic. Don't try to time the market. So remember, we talked about how asset allocation is even more important than that. It's really hard to predict when things will turn back around, or when they will get bad and pull all of your money out and sit in cash on the sidelines. So just the better thing to do is stay the course and just continue to purchase new shares. Keeping your emotions under control when things go awry, just think, hey, this is like the Ask for Christmas special. I'm going to clean up. I got to keep contributing even though the market is down. And last, breathe, because you can do this. You can either choose to be a hands-on investor or a hands-off investor. There's no right or wrong answer. It's just what's most comfortable for you. So our parting thoughts here. Do something today that your future self will thank you for. When you sign up for your retirement plan, it just doesn't feel very good, because you can't see that money, for another probably 30 years in some cases. So it's like you're investing in this thing that's kind of this ever-elusive deal out in the future. But I can promise you that at some point in your career, you will no longer want to show up at your job. You will wish that you had the ability to just be financially independent and kick your feet back and have the choice about how you spend your time. And so for that, you're going to need to create a paycheck for yourself for the future. And that's what this is doing. So taking little bits, not just creating your paycheck for today, but taking little bits out of it for today to make that paycheck for the future, so you've got the luxury of deciding how you spend your time. So make sure you're signed up for your retirement plan and you're putting as much away as you possibly can. Now there's the Financial Wellness Health Center here. We've got the number up that you can call and engage and get some more help and more tools and resources. So we've got that. And with that, I'll turn it back over to Renata.
Thank you so much, Courtney. We really appreciate you sharing your time and knowledge here with all of us today. As you mentioned, we'll start addressing some of the questions that have been filtering in. And please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu, as well as you can always reach out to the number on the screen there, the email as well, for any plan-specific questions or trust-related questions. So our first question here today, we got one regarding the recording of the webinar. It will be sent out to everyone who received the invite in about a week, so look out for that. Any follow-up questions you can direct back to the Financial Wellness Health Center there as well. We got a question regarding what makes a fund blend growth or value?
That's a good one. So blend growth or value. This is another way of differentiating within asset classes. So let's use large cap as an example. So for large companies, a blend, we'll say quickly, is going to be a blend of growth and value. So on the growth side, if the manager has the mandate to look for large companies that are growth oriented, then they may be looking for specific things about their price momentum, that they are an industry leader, that there's a lot of runway for them to outpace the competition, that they're really posed for growth, and that they're maybe like their capital that they expend in order to create revenue for their company is low, that they get a good return on that. So these are companies that are more looking to put up results every single year. On the value side, this is where managers are looking for a good deal. They're looking for a company maybe that doesn't have, it's not fairly valued by the market. Like their stock price is down, but they still have very solid fundamentals about their company. So maybe like an example would be Target would have been a value company for a minute when they had that failed expansion to Canada, but then, and right after that they had the credit card breach. But I mean, it's Target, they had good management, they felt, maybe the manager felt like they still had great opportunities in the future, so that would be more of an undervalued situation, so they would buy it as a value company. So that's the difference between growth and value. When you go to blends, that's a little bit of both.
Great, thank you. Then we got, what does it mean to invest in cash?
What does it mean to invest in cash? Well, basically you are sitting on the sidelines. So instead of investing in some sort of security, like a stock or a bond, you are opting to let it sit in a cash investment. And so that would be like money markets or stable value. So something that's not invested necessarily in the stock market or the bond market.
Thank you. And then one more question here today. So can we invest in target date funds and other funds too within the retirement plan?
Yes, you can. The thing is that they're not really designed that way. You'll have overlap if you do that, in other words. So a target date fund is going to have stocks, bonds, and cash in it already in some capacity, in some allocation. If you go and then also invest in some of the small cap funds or some of the mid cap funds or whatnot, you're now overweighting your portfolio. There's overlap there. So yes, you can. That's not really its intention, though. You really should pick one strategy or the other.
Great. Thank you so much, Courtney. That'll conclude our webinar session here today. Thank you for presenting, and thank you so much, attendees, for your participation. I hope everyone has a great day, and we look forward to our next webinar series with you. April will be a quarterly market update, so that'll get into more the nitty-gritty of kind of what we talked about today and what's current events and how they affect the market. Thank you, everyone. Take care.
Thank you so much. Bye-bye.